The government needs money, but instead of raising taxes, what if it sells a stake in what it owns? That is disinvestment, one of the budget levers that quietly shapes government finances every year. Disinvestment is when the government sells its stake in public sector companies or PSUs. In simple terms, if the government owns a company, it can sell a part of it or in some cases even hand over control to private investors. The aim is to raise cash, reduce the burden of running businesses and allow companies to operate more efficiently. Now, disinvestment is handled by a finance ministry department called DIPAM. The government can sell PSU stakes through IPOs, offer for sale or ETFs, or strategic sales where control changes hands. The money raised from these sales is counted as capital receipts in the union budget. But from FY24 onwards, the budget stopped giving a single standalone disinvestment target. Instead, disinvestment and asset monetization are grouped under miscellaneous capital receipts or MCR, a more flexible, opportunistic approach. For FY26, the MCR target was about 47,000 crore rupees. But by December 2025, only part of this had been achieved, mainly due to delays in strategic sales. And historically, if we see, governments have often missed disinvestment targets. Disinvestment matters for three key reasons. First, it raises money. It can help fund infrastructure and welfare without increasing taxes. Second, it can improve efficiency. Private ownership is often seen as better suited to running businesses than the state. And third, it supports the fiscal map. Disinvestment is a key source of non-tax revenue, helping reduce pressure on borrowing and contain deficits. Now, you should care because it affects you in more ways than one. As a taxpayer, it can reduce pressure on taxes and borrowing. As an investor, it can create more market opportunities through PSU stocks and ETFs. And as a citizen, it can mean a better use of public money if the process is managed well. But when disinvestment targets slip, as they often do, it complicates budget calculations. So in Budget 2026, keep an eye on progress on big ticket stake sales, especially IDBI Bank, and how much spending is being supported through asset sales without widening the fiscal deficit. When the government sells PSU stakes, it earns non-tax revenue. That can reduce how much it needs to borrow, helping contain the fiscal deficit and in turn the primary deficit. But what is the primary deficit and what does it tell us about the government's real fiscal position? We'll decode that in the next episode. This is Budget Basics by Business Standard, breaking down the budget minus the jargon.